Retirement planning starts with setting clear financial goals. A retirement portfolio is a collection of investments designed for long-term growth. Building a portfolio from scratch requires patience and discipline. The first step is understanding how much money you may need in retirement. Experts often recommend estimating future yearly expenses. Inflation should always be included in retirement calculations. The earlier you start investing, the more time your money has to grow. Compound interest is one of the most powerful tools in investing. A retirement portfolio should match your risk tolerance. Risk tolerance refers to how comfortable you are with market fluctuations. Younger investors can usually take more investment risks. Older investors often focus more on preserving wealth. Retirement portfolios should be diversified across different asset classes. Diversification helps reduce the impact of market downturns. Stocks are commonly used for long-term growth. Bonds are often included for stability and income. Cash investments provide liquidity and safety. Real estate can add diversification to a retirement portfolio. Index funds are popular because they offer broad market exposure. Exchange-traded funds are another low-cost investment option. High investment fees can reduce long-term returns. Investors should compare expense ratios before buying funds. Emergency savings should be built before aggressive investing begins. Financial goals should be reviewed regularly. Retirement planning requires consistency over many years. Small contributions can grow significantly over time. Budgeting is essential for creating investable income. Debt reduction can improve retirement savings potential. Tax-advantaged accounts can help investors grow wealth faster. Employer retirement plans often provide valuable benefits. Some employers offer matching contributions. Employer matches are considered free money by many investors. Retirement planning should include healthcare considerations. Medical expenses can increase significantly during retirement. Long-term care insurance may help reduce future financial stress. Investors should avoid emotional decisions during market volatility. Market downturns are a normal part of investing. Staying invested is often more effective than timing the market. Financial education improves investment confidence. Retirement planning is a lifelong process. Every investor has unique financial circumstances. A written retirement strategy can improve discipline. Reviewing progress annually helps maintain focus. Consistency often matters more than perfection in investing. A strong foundation makes building a retirement portfolio easier. Most people think picking stocks is the hardest part of investing, but here's what actually breaks portfolios: putting everything in one place. Index funds like the S&P 500 spread your money across hundreds of companies at once. Then you add bonds to cushion the drops when stocks get volatile. The percentage you put in each, that's where your age and risk tolerance actually matter. Smart allocation beats perfect stock picking every single time. Consistent investing is essential for long-term portfolio growth. Many investors use automatic monthly contributions. Dollar cost averaging reduces the impact of market timing. Investing regularly can build discipline over time. Portfolio performance should be monitored periodically. Long-term goals should guide investment decisions. Investors should avoid panic during market downturns. Emotional investing can damage long-term returns. Staying invested during volatility often improves outcomes. Retirement accounts may have contribution limits. Investors should try to maximize tax-advantaged accounts. Roth accounts can provide tax-free retirement withdrawals. Traditional retirement accounts may reduce taxable income. Tax planning is an important part of wealth management. Capital gains taxes can affect investment profits. Tax loss harvesting may reduce tax burdens. Portfolio diversification should be reviewed yearly. Some investments may outperform others over time. Rebalancing helps maintain target asset allocation. Inflation can reduce future purchasing power. Growth investments help combat inflation. Interest rates can influence bond performance. Economic cycles affect market conditions. Investors should prepare for both bull and bear markets. Emergency funds should remain separate from retirement savings. Liquidity is important during financial emergencies. Investors should avoid withdrawing retirement funds too early. Early withdrawals may trigger taxes and penalties. Financial discipline supports long-term success. Lifestyle inflation can reduce savings potential. Increasing income can accelerate retirement contributions. Side businesses may create additional investment opportunities. Financial advisors can provide professional guidance. Fee-only advisors may reduce conflicts of interest. Investors should verify advisor credentials carefully. Retirement projections should be updated regularly. Life changes may require portfolio adjustments. Marriage and children can influence retirement goals. Healthcare planning becomes more important with age. Insurance can protect retirement assets from unexpected events. Estate planning helps preserve wealth for future generations. Wills and trusts are common estate planning tools. Beneficiary designation stagnations should be reviewed regularly. Patience is critical when building long-term wealth. A disciplined strategy can help investors achieve retirement freedom. Most people think retirement planning ends when you stop working, but that's actually when the hardest part starts. You have to shift from building wealth to making it last. The 4% rule says withdraw that much each year, but market crashes can wreck their plan. So you need cash reserves to avoid selling when everything's down. Mix in bonds for stability, dividends for cash flow, maybe even part-time work if you need it, because your expenses will change, healthcare costs will rise, and your plan needs to evolve with you.